When you think of the classic fairy tale of Robin Hood, you probably remember those old TV shows of a charismatic young man who stole from the rich to give to the poor. Even the more recent depictions of the character have been wildly popular. And let's face it, everyone knows who Robin Hood is. It's easy to get the popular investing app Robinhood confused with the actual Robin Hood. After all, the company got its name from the mythical guy who took from the rich to give to the poor. And that's what the company once stood for. Robinhood's mission statement was to democratize finance for all. The company believes that everyone should have access to the financial markets. When Robinhood first came out in 2013, this goal was nothing short of being revolutionary. Before Robinhood came into the market, investors had to pay when they bought or sold stocks. This was a massive barrier to entry to retail investors, those seeking active trading, and people who didn't have a lot of money but want to invest. Think of someone who doesn't have a lot of money. Maybe he's a college student who has a few $100 in savings, or a single mom who wants to invest a few dollars every week, but that's all she has. Vanguard, also a popular investing platform, has offered low-cost investing for over 50 years. But even for Vanguard, you need at least $3,000 to open an account at the time. With over half of the population living paycheck to paycheck, it's easy to see why these kinds of people don't invest. Take millennials. According to Robinhood, 68% of them have no money invested at all. It's hard to put $3,000 aside if you're paying off student loans or living paycheck to paycheck. Robinhood wanted to change this, giving these people a place to have their hard-earned money grow over time, be it to save a little bit for college, have your money protected from inflation, or simply if you want to learn about investing. This was Robinhood's mission. These people eventually came into the financial markets because of Robinhood and its no-commission investing and little capital requirements. Robinhood was the first of its kind. Other companies followed suit. Online brokers like Charles Schwab, E-Trade, and TD Ameritrade have dropped their fees since Robinhood first came out. But they were late to the game for retail investors, and this allowed explosive growth for the company. Robinhood drew in investors by the droves. A year after it launched, it had gained 1 million investors. It doubled this number during the 2 years that followed, and then tripled it, reaching 10 million users by 2019. It's up to 20 million this year, and became the most downloaded app earlier this year during the trading frenzy of meme stocks. But this explosive growth didn't come without backlash. What drew in retail investors was also the reason behind Robinhood's vast scrutiny. The company has been accused of making gambling out of investing, what some consider to be gamification. Robinhood has been quick in adding features like investing on marking and encouraging its users to be active traders by sending notifications and happy emojis when orders are fulfilled. Essentially, it makes investing feel like a game. If you use Robinhood, you know what it feels like going rock bottom when your positions plummet. The screen goes red and you feel like you're losing money, even though you only lose money when you sell. Investing your money like this makes planning for the long run impossible. The temptation to sell is too high. At the same time, the thrill you get when the screen is green makes you want to gamble more of your money. Robinhood offers one of the easiest interface trade platforms in the market. It's easy to buy stocks. It's easy to put money in, take money out, open your account, close your account. It's fun. While these features are common with active trading apps, it was Robinhood that first put them to the test. Ultimately, Robinhood's strategy didn't work to get people into what Warren Buffett would call investing. It got users to be traders, not investors. For many, this developed into gambling. This became what users sought for in Robinhood. They wanted active trading, not long-term investing. And this is where the company's vision fell with the demand of its consumers. Just days ahead of its announcement that the company planned to go public, Robinhood was fined $70 million over misleading customers and system outages, by the Financial Industry Regulatory Authority, which is the country's legal authority to protect investors from potential fraud and abuse by financial companies. This was the largest fine to ever be imposed by the agency. Robinhood had already paid millions of dollars in fines after breaking banking regulations, including $65 million to the SEC for misleading customers about its business. This latest fine was caused by Robinhood's unexpected outage in March 2020. Robinhood failed to explain the causes behind the outage to its customers, who couldn't trade during the outage. Regulators said Robinhood failed to follow rules that were designed to protect investors and the markets. The agency also faulted Robinhood for various system outages between 2018 and 2020 that locked customers out of their accounts during huge market swings, saddling some traders with thousands of dollars in losses. When Robinhood finally halted trades on certain stocks earlier this year, nearly 50 customer lawsuits were filed. While the public has learned about the restriction of trading during this year, Robinhood has been using these same restrictions for a long time now. It is only now that traders have finally gotten tired of the company blocking certain features of the platform because of high volatility. Many traders have felt cheated by the company, whose sole name signified some hope for retail investors versus big hedge fund managers and Wall Street. The lawsuits accused Robinhood of purposefully, willfully, and knowingly removing the stock GME from its trading platform in the midst of an unprecedented stock rise, thereby depriving retail investors of the ability to invest in the open market and manipulating the open market. Robinhood has gained a reputation for democratizing investing, as its mission statement says. It established a brand that encouraged everyone, regardless of income level, to invest in the market. But, like Warren Buffett says, it takes 20 years to build a reputation and 10 minutes to ruin it. Robinhood was ruining its reputation for over 2 years. It was about time customers took action. After Robinhood halted trade in various stocks, Vlad Tenev, the CEO and founder of Robinhood, was summoned by Congress to explain the restrictions on trading. Lawmakers accused Robinhood of deliberately blocking purchases of stocks to safeguard the positions of big financial companies the company had ties to. Big financial firms like Melvin Capital had shorted massive amounts of GameStop stock in hopes the company would fail, like other big brick-and-mortar stores that had once dominated American industry, like Blockbuster. Conflict of interest arises when you look at how Robinhood makes money. Most of the revenue Robinhood makes isn't from charging fees on margin interest or its gold account subscription offering. Most of the money the company makes comes from other financial institutions like Citadel, which pays Robinhood to execute customer orders. Brokerages and hedge funds like Citadel offshore many trades to companies like Robinhood because of the better interface they offer and because companies like Robinhood can reach a different demographic. In return, Citadel pays Robinhood a small fee every time they execute an order. 1 month before Robinhood blocked GameStop trading, Citadel invested heavily in Melvin Capital. It upped that investment to $2 billion earlier this year alone. Melvin Capital then poured this money in shorting GameStop and other securities the hedge fund thought would fail. In light of this information, the Wall Street Bets thread on Reddit urged traders to put their money in these meme stocks, raising the price of GameStop alone from $20 at the beginning of January to more than $350 in a matter of weeks. The gains came at the expense of Melvin Capital, which had bet against GameStop. The hedge funds sustained losses of billions of dollars, while retail investors saw massive gains. By the end of January, the hedge fund had lost half of its entire asset value. In short, the financial firm responsible for most of Robinhood's revenue was heavily invested in another financial firm that was going bankrupt in a matter of days. Robinhood then prevented its users from buying the stock, but it didn't prevent them from selling it. By the end of the day, GameStop was down by 44%. Kenneth Griffin, the founder of Citadel Securities, said no one in his company had any discussions with Robinhood about restricting trades in GameStop, but the possible conflict of interest made many question whether Citadel Securities had anything to do with the ban. Robinhood was founded on the belief of democratizing financing for all. With the massive losses of Melvin Capital and the rapid wealth attained by retail investors, the company should have been rejoiced. Had it been true to its original mission statement, Robinhood should have been happy that its customers were making big bank at the expense of big financial firms and the establishment. Both the public and lawmakers across the aisle claimed Robinhood and other trading platforms were hurting retail investors to help the rich. Congresswoman Maxine Waters, who heads the House Financial Services Committee, said that
many Americans feel that the system is stacked against them, and no matter what, Wall Street always wins.
In turn, Robinhood blamed financial regulations for what had happened. CEO Tenev said that Robinhood had to stop the trading of GameStop and some other stocks because of the increased volume at which these positions were being traded, which he said required the platform to comply with new legal requirements for higher volumes of trading. Still, that doesn't explain why investors weren't allowed to buy, but were allowed to sell. If Robinhood wanted to stop trading altogether, they should have stopped both. If it's true that the massive stock increases forced the company to comply with new regulations, then it should have at least informed its customers that. In the end, what Robinhood did, as the many lawsuits claimed, was purposeful market manipulation, whether it was for legal reasons or not. Robinhood didn't inform its users of the reason why it had blocked trading until much later on, after Vlad Tenev apologized for the mishandling of the situation by his company. The reactions from the company and its ties to big hedge funds made it clear whose side Robinhood was on. GameStop stock crashed following the news. So did AMC and many others. Robinhood continued to restrict trading for these stocks to keep the stocks further down. At one point, Robinhood allowed a maximum number of shares of GameStop of just one. It didn't allow trading options, no borrowing for stock, which is one of the features of a margin account, for which users pay fees. It discontinued recurring investments, fractional shares, and it discouraged people from trading altogether, saying that trading is not investing. These types of features were the reasons millions of people joined the app. Now, Robinhood was taking them away from its investors as they had the opportunity to make bank. Users were furious. Negative reviews plagued the Google Play Store and Apple's App Store. There were so many one-star ratings that Google started removing tens of thousands of them. Following the trading restrictions, a survey found that 56% of account holders in Robinhood were considering leaving the app. Investors started looking at Robinhood as just another big financial firm that helped the rich at the expense of the poor. In a survey by Fortune.com, investors viewed Robinhood as one of the most unfavorable financial services companies. The only other company that scored that low was Wells Fargo. Backlash has continued, even until now. When Robinhood first announced they were going public, experts expected the company to have one of the best IPOs in history. But when the company finally went public, it received the worst performing IPO out of all 51 American companies that raised at least the same amount of money. It's no surprise that so many people are leaving Robinhood. Rather than stick to its initial mission statement, help the poor, Robinhood has sided with big hedge funds and the rich. Robinhood has constantly stolen from the poor by not letting them rip the gains out of market swings and given to the rich by blocking purchases of many stocks during these market swings, especially when these securities have been shorted by those who have ties to Robinhood. Robinhood's social media pages and reviews have been plagued with negativity. This wasn't always the case. When the company first came out, its mission to democratize investing for all and help the poor resonated with millions of Americans, who later joined the app. Robinhood was once loved by its customers and the public alike. After they stole from the poor to give to the rich, this isn't the case anymore. If you're using Robinhood, are you planning on leaving anytime soon?